Good evening, folks. Samson Jagoras here, VUE Properties, and excited to bring you another investment opportunity. This is the Drake and Chetwynd apartments located in Des Moines, Iowa. And I think as we dive into this, you guys will be just as excited as we are about the Midwest, and specifically this asset in Des Moines in the submarket where it's located. This is a 136-unit apartment complex across 6 different structures spanning 2 adjacent properties that are really managed as one. And it is a great C+ asset located in a great B+ submarket where we can do some light value add to this in order to maintain some great inventory on the affordable housing side. And there's still about 110 units to be renovated, which offers a ton of upside from a value add game plan. But before we jump into that, it's important to just disclose, per usual, investing carries risks. Specifically, investing in real estate is important for everybody to assess their own personal financial situation. Throughout this webinar, we're going to be speaking a lot as it relates to pro forma and forecast projections based off the historical performance, as well as our investment thesis as commercial real estate professionals and insight from our local third-party experts. As you dive in and decide to move forward with investing, you're going to get a disclosure as well as all the private placement memorandums and the financials and the full financial model and the pro forma, where you can really deep dive in to figure out if this is a good fit for you. The purpose of this webinar is to see if you have any interest so that you can decide to take next steps, and you can hear our high-level overview and thesis. So without further ado, my name is Samson Jagoras. I'm one of the principals, the Chief Strategy Officer and CEO. And this is my partner, Jeremy, and my other 2 partners, Brad and Justin North. And together we make up the VUE Properties team. We are super pumped to be partnering with Hammer Hampel. One of the main reasons being is not only are they great dudes who have an experience in commercial real estate, but they also have a foothold in the Des Moines market, which is a place where we really want to be. And so we're going to be working with them as well as Lloyd Companies, who oversee some of their properties and has a strong foothold in the Des Moines market. They have 7,300 doors under management currently. As you can see here, we're working with some other great partners, from SEC and real estate attorneys to cost segregation specialists, CPAs, and multifamily utility company who's going to be helping us with the RUBS implementation. So rock solid team and a bunch of people who understand the real estate market. And as you know, one of the things I always hammer home is why real estate, because I think it's important as we're in a flux in the market for people to just understand the long-term outlook on real estate and why commercial multifamily continues to make sense. So most importantly, it has low downside risk, safe and consistent returns, and an evergreen life cycle. It is an incredibly important part of our fundamental needs, which is food, shelter, and water. And so because of that, it is not getting Airbnb'd out of existence. There's not technology coming in that is replacing it. If anything, technology is enhancing the way that we live. And so as a result, it continues to be one of the best places for capital preservation, cash flow, and increases in equity. And through forced appreciation, we can really drive that equity growth over time. Historically speaking, real estate has also outperformed the stock market in terms of annualized returns. So historically speaking, the annualized return on real estate is 10.71% when you compare that to the S&P 500, which tends to roll around 6.14%. Already alluded to this, but it's a fundamental human need. So people need a nice, safe, clean place to live. And specifically as things continually get more expensive, having affordable, attainable housing, maintained inventory on the market is incredibly, incredibly important. That said, even though people are moving and looking for attainable housing, they still want to be in a place where they can have a relatively good quality of life. And so urbanization has been on the rise since 1950. Even though we're seeing some people move out of the core downtown city centers, they still want to be near amenities. They still want to be near things to do. And so the Midwest, and specifically Des Moines, as you'll see, has all those luxuries, but it's still not overcrowded, and it's still a very affordable place to live. Not only has home ownership rates gone down, but as we've seen interest rates go up, we've seen purchasing power and leverage for first-time home buyers go down significantly. So that's continually driving this trend to a delayed homeownership rate and a lower homeownership rate than we've seen historically in the past. And then on top of that, there's 67.5 million people between 20 and 34, and 67% of those people rent. And that number has only continued to grow for the obvious reasons that I just alluded to, which is low income growth, higher interest rates, and less leverage. So it's harder and harder to get into these first-time homes, plus the cost of building has gone up. So everything's just generally more expensive. And that number is not expected to slow down anytime soon, because you also have this wave of baby boomers that are going to be retiring and downsizing and potentially moving out of the home ownership market and into the rental market, just to get a smaller footprint. By 2030, we expect to see 100% of all the baby boomers over the age of 65, which means they're at retirement age. So this number that you're seeing here on the screen is only going to continue to rise. Risk-adjusted returns. So the relative return to the amount of risk that you have to take in real estate is one of the things that makes it the most attractive from an investment standpoint. It's even better than small cap stocks, large cap stocks. And the only thing that maybe is slightly better would be corporate bonds. But even then, the overall annualized return tends to be better. So on a relative scale, it tends to be better. And if you look down here on the lower bottom right, you can see the commodities. Those are very, very high risk, very, very high leverage. Right. And I actually used to be a longtime commodities trader and broker. And that was one of the things that pushed me out of the commodities and into core commercial real estate is the risk-adjusted returns. It's also a proven inflation hedge. I think we've seen that very, very clearly over the last 2 years. At the beginning of the pandemic, we saw what happened with the stock market. We saw that real estate held pretty strong and has continued to climb and hold strong, even as we've ridden into some more economic uncertainty over the last couple of months. And since 2008, it has continued to go up and up and up. And that's another example of how real estate has more up years and less down years than stocks or bonds, historically speaking. And then last, but certainly not least, one of the beautiful things about real estate is it's not very liquid. So that actually removes some of the volatility because it's not very easy to move in and out of real estate. And so as a result, you have a very low volatility rating. The only thing that's better than that are credit bonds. But you can see in comparison to high yield bonds, large cap stocks, small cap stocks, international stocks, and publicly traded REITs, it's nearly 2 to sometimes 3 times lower on the volatility rating. So that's the historical data. Let's talk about the fundamentals that are going to be driving demand for apartments. The biggest driver is a lack of inventory. Right? We're seeing an increase in household growth and a loss of stock, which means we need to see 328,000 new apartment units delivered each and every year nationally in order to keep up with the growth in demand. We already lose 75,000 to 125,000 apartment units to age and obsolescence every single year. So when you throw that in combined with increase in labor costs, increase in material costs, land, and so on and so forth, the prospects of actually being able to deliver more inventory to the market is getting harder and harder for developers to make sense of that money and that investment. And so this need to keep inventory, older inventory on the market and renovated through value add plans like we're doing here on the Drake and Chetwynd is increasingly important to maintain the inventory stock for the growing demand of apartment complexes. All right, jumping into Des Moines itself. So overall, the greater metro has about 877,000 people in it, and it is the fastest growing Midwest metro out of any of the major Midwest cities. 877,000 makes it the largest metro in all of Iowa, but it continually is one of the places that has, the safest rating and the safest place to live. It's got great jobs and cheap housing. It's also an emerging tech market. It's constantly rated top for business and careers. And it's also rated one of the best places to live after the pandemic, most likely because it's not a very crowded city, but you get all those city amenities and features, and it's very affordable to live with a ton of great jobs and technology, so on and so forth. Over here on the left, you can see just overall employment growth has continued to be strong. I mean, overall unemployment in Des Moines, Iowa is, sub 5%. and the employment growth continues to crack that 2.7 to 3% mark each and every year. And population has been about 15% over the last 10 years or better, as you can see here, since 2010 on the lower left-hand side, that Des Moines has been hitting about 16.7%. So what are the things that drive that? Well, a lot of it has to do with just the good, diverse economy. So first off, it's the #1 insurance hub in the United States. It's the third largest in the entire world. But they also have advanced manufacturing, data centers, tech, agriculture, bioscience, healthcare, and government. So all in all, gets about a rating score of a B+. And then as we drive down into the submarket, we look at specifically where the property is located in the Drake North submarket. The population has continued to grow, specifically in that area, pretty significantly, 15%. Unemployment in that submarket is about 1.5% compared to the 3.4% national average. And there's strong median household income that's right around the national average, with a decent rental price of $1,070. So rent growth in the North Drake hit about 10.4% in 2021, registering like some of the best performance on record for Des Moines. And there's an extremely low vacancy rate in that market of 3.2%, mainly because there's just not a lot of inventory, so there's just not a lot of places to go. Some of the major employers in Des Moines, Iowa that we like is obviously Facebook Data Center, Microsoft Data Center, Apple Data Center, Amazon Fulfillment Center. Those are all within about 20, 25 minutes of the actual location of the property. And then some of the other major employers would include Principal, which is a financial services company, Vermeer, Casey's General Stores, and Hy-Vee Inc., which is bakery and distribution. So good, diverse job set, lots of tech moving in there, lots of insurance, and just a good, diverse economy, which is one of the major things that we look at in order to keep us safe and protected against any kind of economic turmoil. Now let's dive into the details on the property. So you can see here highlighted the two different adjacent properties. I think I mentioned this earlier. They're about 4 minutes apart from each other, but they're just pretty much right next to each other. 6 different structures, 136 units. There's 113 units at the Drake, 23 units at the Chetwynd place. And it's about 98% occupied as it stands today. And there's about 110 of those units that haven't gone through a renovation plan, which is really one of the primary ways that we're going to be able to drive the rents and be able to get the rent top on this deal. But it's also just really well located. So it's within 30 minutes are 608,000 of those 877,000 people. The worker population is 330,000. The median household income is 71,000. You're right next to Drake University. And at first that was a kind of a major concern for us that it was so close to the university. We were worried that there's going to be a large student population, but it actually makes up only 12% of the total tenant base on this property, which is great. You're next to Des Moines University, Roosevelt High School, Perkins Elementary, and then within 3 miles, there's some major employers like Wells Fargo, Principal, Mercy Hospital, and Des Moines International Airport. There are some amenities in place already: swimming pool, laundry, outdoor grills. Those are all things that we plan to enhance. You can see that the pool itself needs a little refresh. The landscaping outside is nice, but it could use a little touch up and refresh, as well as just better curb appeal in order to attract a greater tenant base that's willing to pay a little bit more. And you can see here some examples of renovated units. So we just continue to plan on moving forward with the same renovation plan, and we'll get into those details on the specifics of what that costs on a price per unit. All right, so deal highlights. So the purchase price for this 136 units is $9.75 million. We have a rehab budget of $1.1 million, and we are raising $4.5 million. We have already raised enough to close the property, and we'll actually be closing here in about 8 days. The remaining $1 million in the rehab budget will be raising over the next 30 days. And I'll get into those details as we get further to the end of this presentation on how you can get involved. Our plan is to hold the property for 5 years and drive the rents up, get our occupancy to around 95% or so, which means we're right in that sweet spot of the appropriate rent to the market. And we anticipate getting an 8 to 10% cash on cash return, which is about 100 to 160% total return on your money after 5 years. And that equates to about a 15 to 20% IRR. The split is going to be an 80-20, so 80% to the limited partners, 20% to the general partners. And for this deal, since it is a 504 offering, allowing accredited and non-accredited investors into the deal, our minimum investment is $40,000. So how do we drive value? On the left-hand side over here, you can see the business plan for the interior scope and the exterior CapEx projects. So on average, we're going to spend about $4,800 to bring all the units up to market in order to get that $87 premium, which equates to about $528,000. And then on the exterior CapEx plan, we're going to be fixing the parking lots, improving the on-site storage units, the garage roofs, exterior paints, and then we have a 10% buffer built in there. So that totals about $407,000. So in total, our total renovation plan is about 1.1 million, give or take. And as you can see over on the right-hand side, the main levers that we have in order to improve the value on the property are going to come through renovations and improvement of the amenities so that we can increase the NOI with about $87 premium per unit. And then expense reduction. So the current utilities are being shouldered by the current property management. And so we're going to be installing a ratio utility bill back system, which will allow us to bill back some of those expenses and improve the bottom line pretty substantially. And then last, tax savings. So we will be doing a cost segregation study, which will be passed down through to all the LPs, which will be another way that will drive the return on investment for all the investors. So in total, after the full business plan, by renovating the units, improving the loss to lease, installing the RUB systems, adding the storage units, there's about $2.38 million worth of potential value that we should be able to drive on this property on our pretty conservative numbers and exit cap. And after the 5-year hold, we'll be either refinancing, selling, or 1031ing the property. So how do we know that those numbers are going to work? Well, that's based off of all the comp sets that we've ran of the properties in and around that are similar in style, grade, and bedroom count, bedroom blend. And so there's 6 properties that we've looked at that are 1-1s, and then 5 properties that are 2-2s. And you can kind of see those are all scattered out right here around the Drake to give us our comp set, which you can see here. And you can see that the average comps are showing about $1.28 a square foot on the 1-1s, where we're sitting at about $1.21 to $1.10. And the 2-1s are sitting at about $1.22, and we're sitting at $1.07 to $1.93. So a ton of opportunity to drive up these rents in order to get them to market. And we'll do that primarily through the business plan of adding and upgrading the value of the units. Here's a specific example, just digging a little bit deeper on a 1-1 comp set here. Comparing this property, Old Main, which is about 1.1 miles away. You can see that they're doing carpet, LVP. We're planning on putting LVP in. They have laundry. We have coin laundry. They have storage. We're building storage, which is something that a lot of people want because there's just not a lot of storage to be had. They have outdoor gas grills. We have outdoor pool and gas grills. They're getting about $820 to $870 a month. We're currently getting about $664 a month for that same style and size of unit. And then on the 2-1s, here's a good rent comparable University Terrace. Pretty much our amenities line perfectly, and or what we're going to be adding from a value add standpoint And you can see they're getting about $1.23 a square foot, and we're getting about $1.07. So investment summary. Left-hand side, really clean way for you to see 100K investment, what that looks like from a cash flow, refinance, and total percent return. And then on the right-hand side, you can see more of the core metrics, return summary, internal rate of return for the limited partners at 17.4%, cash on cash return at 7.4%. Annualized return works out to about 13.2% and an equity multiple of 1.66. So on something that's stabilized in cash flow, those are the numbers that we like to see. We're also going to be doing a cost segregation study, as I alluded to, which will allow us to bonus depreciate the losses in the first 1 to 5 years. And we anticipate seeing 50 to 80% tax loss on your initial investment in year 1 on your analyzed K1. And that's it. Next steps, like I said, we are closing on September 8th. We are continually raising over the next 35, 36 days for the CapEx budget, which would be about 1.1 million. And if you would like to get into this deal, you can click the link and head over to the deal room to fill out all the details in and around the private placement memorandum and subscribing to the deal. You can also email Brad at the Growth View or call him directly on his cell. And or I'm always available to you guys if you need anything from me and you are somebody who has a close relationship with me, feel free to reach out. Happy to walk you through the deal, tell you why we love it, why we're invested in it. Appreciate everybody. Thanks and have a great night.